Today we're going to take a deep dive into a few price action strategies, and I will show you exactly how to get into the trade, what is the best entry possible, how to do a top-down analysis, where do you put your stop so that it is protected, how do you choose the right exit, what is the perfect reward to risk ratio, how do you design your risk, and everything else that you need to do, and only price action, nothing else, 100% price action in this video. And as you can see, it says part 1 here. So there's going to be part 2. And if you want me to continue this series, maybe make part 3, 4, 5, and so on, leave a comment below, smash the like button, and also make sure to subscribe to my channel. In the first price action strategy, we're going to talk about a top-down trend continuation approach, how to get into the perfect trade. And we're also going to take a look at stacked targets, which means how do you scale out of the position, how do you choose the right exit, and what is the difference between different exit strategies. The first step when we take a look at a chart, we need to zoom out and we need to understand what is the market state, what is the trend direction that we are in. And what do you think is the current market direction here? The primary trend is down. I hope you all got this right because it's pretty clear from the top left to where we are right now. The market moved lower. Obviously, the market doesn't move in one straight line and there's always going to be ups and downs, such as here, the market made a correction wave. But this is actually what we need for a continuation. If we want to get into a short, into this primary downtrend, we need for the market to actually correct because that gives us a better entry price when the market is moving higher. Because if we want to sell, we want to sell for the highest possible price. So now we zoom in a little bit. We are still on the same time frame. And now we're going to start to understand where's the confluence, what are we looking at, where are structures, and what is happening here on the most right part. So as we've seen on the higher time frame, the market was in this correction phase. It moved higher in the overall downtrend. And what do we have here in the microstructure when we just look here at the right hand of this chart? We can see that the market did move higher. It topped out here with this double top. It then moved lower and it paused here. So we have a downtrending initial trend and it stopped here. The market is giving us a head and shoulder continuation. Head and shoulders are often used in a reversal context when they exhibit or when they exist at the end of a mature trend. They will often signal the turnaround of an existing trend. However, in this context, it shows us that the market was in a downtrend. The head and shoulders shows us that the market made a higher high from the left shoulder to the head. And then from the head to the right shoulder, the market made lower highs. So this is a great continuation context. We can see that the market is already trending lower here in this right part, and that the attempt to get this market to turn around and to continue this correction wave higher seems to be not as strong. And yes, there was a strong bullish push, but it seems like that here with the head and shoulder, there is a lot of weakness coming back into the market. We can also add, for example, the Fibonacci levels. So we draw our Fibonacci from point A at the top to point B here at the bottom of this trend wave. We then look for where's the retracement. It's happening pretty close to the 50%, which is good. And we're going to use the Fibonacci extensions to define our targets. Generally speaking, when you see that the Fibonacci retraces to 50, it's very common to see the 138 or 161 trend continuations. In later parts of this video with other strategies, I'm going to give you a few other different target strategies and ways how to get out of your trades. But let's start with the Fibonacci extensions. So we're going to take off our Fibonacci extensions now because we only need to know where's the 138, where's the 161. And what else do we need to do is we need to wait for the market to clear this level. We want to trade with a confirmation breakout, which happened here. Just shortly after, you can see we have here our head and shoulder. We have the right shoulder here being significantly lower than the head, which is important. And we have even one more confluence point. Confluence point being that from the right shoulder, the market made even another lower high. So we are already continuing this trend structure here, lower highs here on the right, which means that we could be looking at the start of a new downtrend. The market needs to now break the lows, which it did now. And you can see this is also the neckline break. So we have a lot of confluence. Let's quickly just recap what we are looking at actually. We have the higher time frame primary downtrend that we are trading into. We have also the head and shoulders structure, which shows us that the correction wave that we are seeing is over. We're seeing that here the market is making lower highs. We're seeing here that the market is making here even another lower high, which is sometimes referred to as the lower bounce or the breakout buildup. So we have so many confluence factors that we can use here on our side. We have a high momentum breakout, and that is 5 confluence factors that we have here on our side. So this makes for a great trade. And again, we're going to take a look at various different strategies, trade examples in this video, and I will show you how to use different kinds of confluence factors to create a very, very robust trading approach. And then you have options, obviously. Now you can say, okay, we have our entry here. Stops are always first, and stops need to be protected. And you protect stops by putting them behind support and resistance levels. So we can use this neckline. We also use this previous swing high. And then we put our stop loss not at the swing high, because obviously volatility is an issue, spread can be an issue, so we want to give this room a little bit of an extra buffer. So we put the stop loss a little bit above this high that was here. So now we have 2 levels of protection behind our entry price. So our stop loss is protected by the neckline and also by the high. So a solid stop loss place to have. For targets, you have choices. Do you want to have the first one, which is the 138 fib, or the 161? You can also stack your trades or stack your targets. So you could, for example, say I get out with my first position here, and then I take the full trade exit here. Or what you could do is, if you don't want to scale out and reduce your potential profits, is when the market hits the first target, you move your stop loss to break even or to another point that the market is then offering, and then you let it ride out. You can see now the market has made lower highs and it is already at your target 2. You can also see that the market is moving strongly down. So what you could do is, if you don't want to be out of this trade, is you could think about extending your target. And for that, first of all, you should always protect your position. And for that, we could, for example, move our stop loss to this place now, which is above this swing high and also above the Fibonacci retracement. So our stop loss is again very nicely protected. And we want to zoom out to understand, okay, where are potential target areas next? So you can see this is the 138, 161 here. And now we're zooming out and we look for other areas of value. We can see here is a very, very big support and resistance area. Previous support turns into resistance. And here also a huge level that really stands out. And we could use them in our trading. So I've marked those 2 levels here. Now for us, you can see this is where we left off. Here's the 3rd target and the 4th target. So now let's see what is happening actually. First of all, the market cleared the target number 3, and you can see the market keeps making lower highs. What you can do is move your stop loss. Again, we have moved our stop loss to this place. We can move it to this or above this area, which is the 161. It's also here the last swing high. So this would be a very reasonable area for your stop loss. And then you could say, okay, I still want to be in the trade. Maybe I'm a little bit greedy. Maybe my last trade wasn't too good and I tried to make up. So I'm going to push my luck and I will extend my target to the final and 4th point. And the market never reached it. You can see the market came very short of it. It didn't fully reach it. And this is now the trade-off between the target size and your win rate, and also the holding time. And I will talk about this in later parts of this video, because this is a very, very important concept. Because what you will see is that the wider your target is, obviously, the market will have a harder time reaching it compared to a target that is much smaller and much closer. And this should make sense, because the closer the target, the easier it is for the price to reach it, and therefore your win rate will go up. Obviously, you need to find a sweet spot, and some traders just prefer to have wider targets. They don't mind the lower win rate, but also one thing that you have to take into consideration is that your holding time will go up significantly. And especially if you don't trade the lower time frames, what happens is if you have wide target, it means that obviously you have to hold your trade for a longer period. Sometimes you will have to hold through the night, sometimes over the weekend even. You have to hold through some news events as well. And all of those factors are going to increase the level of risk a little bit. So it really depends on your personal preferences. Where do you would like to trade the strategy? Do you like high win rate, lower reward to risk ratio, but you're in and out of the trade very quickly? You don't have to deal with any of those other risk factors. Or are you okay with accepting some of those risk factors and you prefer to go for a little bit of a wider target? In strategy number 2, we're going to take a look at how do you trade wave 3 continuations and how do you actually get into a trade if the first one fails. So now we are taking a look at the higher time frame first, and here we want to understand the trend structure, and this is going to be a really helpful trading strategy if you are looking to trade trends. So we can see the market has made a wave 1, it broke into a new low, and that's when a new trend wave count is reset. Then we have a short wave 2 into previous support, so now support is also turning into potential resistance. Obviously at this point we don't know yet because the market has just arrived at the level. It could as well just move higher and not care about any of that, but we're going to develop a trading plan for a wave 3, which is the continuation in the primary downtrend. So now we're going to take a look at the lower time frame, whereas previously this is the 4-hour time frame, as you can see here in the top left. Now we are looking at the 30-minute, and on the 30-minute we want to understand the time frame structure, trend structure. We want to look for areas of confluence and develop our trading plans. So when we zoom in, we can make our first chart markups. We can see that we can very nicely apply a trend line here. We have 1, 2, 3, 4 touch points here on the trend line, which makes this a very valid trend line. A trend line is kind of subjective, or at least it's more subjective than a horizontal support resistance level. However, having 4 touch points on a trend line is already quite good, but we can improve our decision making by looking for other confluence factors, which comes in here with this breakout level or previous flip level. So this is a resistance level, and we're going to use that for additional confluence. So we want to make sure that if we want to trade short, because that is the wave 3 direction that we have identified on the higher time frame, we want to see that the market is breaking through the trend line and at the same time also through this flip level. This would give us another layer of protection, because if the market can get through 2 important confluence levels, that makes this a more meaningful breakout. Also, we can see here, when we look at the microstructure of these candles, you can see that the market is giving us here this huge engulfing candle. It's a very, very large bearish candle, and that is also giving us some nice confluence. You can see before the breakout, we have another lower bounce. So the breakout buildup or lower bounce is a very, very powerful concept. I've made many videos about this on my YouTube channel, so make sure to check that out. It's a really important pattern. And then you can see we have a breakout. So this is the most important part. A lot of traders will get already very impatient when they see the market is giving you all of the structure. You have the trend line, you have the level, and then the market is coming back here. And you need to be really patient, because only confirmed breakouts should be considered. There are going to be a lot of fake outs, a lot of invalid breakouts, and you can reduce the amount of running into fake breakouts quite a bit by just making sure that you wait one more candle. That's often going to be already a big saver. So now let's take a look at our trade structure. And for the trade structure, we always want to make sure that we consider the stops first. Stops have always go first. And we want to protect the stop loss. As I said in the previous example, stops are protected by levels of confluence and also by price and trend structures. So we want to put our stop loss above the trend line. We can expect maybe a trend line retest is not super uncommon, so we need to account for that. We also need to account for the market testing the structure. Here seems to be a local high, so we want to make sure the stop loss is above this area. And we give it a little bit of extra room, a few points, so that is a little bit more protected. So we have a few layers of protection for our stop loss. To the left, we can see here's the last low, and we could use that as a simple target approach. 2 candles later, we are out of our trade. The market actually spiked against us. The market didn't care about this level at all. It didn't care about the trend line. So we are immediately out. But that's okay. Nothing works 100% of the time. And Moritz and I, we have talked about this many times in our masterclass, in our offline events as well. And there is no perfection in trading. You should not try to reduce the amount of winners until you have a 100% win rate, because first of all, that's never going to work. And also at the same time, you're way better off working on improving your exits, making sure that your winning trades maximize the profits, that you don't cut your winning trades short. That is going to be time well better spent than trying to perfect a trading strategy. So that's a very, very important point. And what are we going to do with this now? Can we look for re-entry? Can we get back into the trade? And the answer is sometimes yes, sometimes no. Sometimes the market is just going to brush through this area. It's going to continue higher, and we don't have a chance to trade our wave 3. But sometimes we will have a re-entry opportunity. And a few candles later, you can see the market actually now made this flip. So the previous support was retested as resistance initially here, and now here we have now a very decent area of confluence. And you can see after the pin bar, the market moved away quite quickly. So we have a very strong engulfing candle here. And this is a potential re-entry opportunity. Some traders may require that the market is making a completely new low, but what I've seen in my trading is that it can already be enough if you see that the market is showing you momentum away from the level. I don't want to take a re-entry right at the level because we don't have enough information, and you're just going to go against a very strong bullish push. But if you wait for the market to move away from the level and show you some sign of momentum, much better. And how we're going to structure our trade, again, we want to put it above this area. We also want to put it now above the new area here and place it outside of the range. So we want to make sure that our stop loss makes sense in this context once again, and we are protecting our stop loss. In the first example, you could have also said we're going to move our stop loss all the way above here. But again, in my opinion, that's not absolutely necessary. Of course, you may be able to avoid some of the losses, but you're also going to cut down your reward to risk ratio quite significantly. So I'm always a fan of not having a stop that is too tight and very aggressive, but it's also not absolutely necessary to put it all the way outside of the range. So in this example, we put it above the recent high. For the target, we use the same target because to the downside, nothing has changed. So we don't need to adjust our target and we can just reuse it. So very simple approach, and let's see what happens. The market has moved into our target and we are out of the trade. And there are a few very important lessons here. First of all, re-entries are common. Re-entries are possible if you get an actual signal. You don't just jump blindly into a trade and you end up doing revenge trading. You need to wait out for the market to actually give you another valid signal. Also, there's a trade-off between win rate, stop loss, and target size. Again, you can put your stop loss all the way above it here. Totally fine, you would have avoided this loss, but you will also cut your reward to risk ratio short. In my opinion, what is better, in my experience, what is better is maybe a little bit of a tighter stop loss. Then your win rate will maybe be not as high, but your reward to risk ratio is going to be much higher. So the design of our reward to risk ratio will help us to also control the win rate to a certain degree. Trade number 3, strategy number 3 is a flip zone continuation, and this is particularly very interesting if you are a new trader or if you are just looking for a very simple, straightforward approach for a trend trading strategy. Many people say that price is king, but in my opinion, price is second, and first of all, it's confluence. Confluence and context are really king. And when we look at a higher time frame, such as the 4-hour, then we want to understand, first of all, what is the primary trend. The primary trend is down. The market topped out here and started making lower lows and lower highs. Secondary trend is currently here we are in a pullback. So we are in wave 2 or wave 4. And we are also having a level. So we are also looking for the market and the pullback to end at a level that makes sense overall. We also have a micro pattern on the higher time frame. This is a 3-candle reversal, which is in my experience one of the most important and most reliable reversal patterns. This is a really nice signal if you can get it in the right context and in the right confluence. So now we're going to go to a lower time frame, and this is the 30-minute time frame. And on the lower time frame, we are looking for support areas, resistance, any value area. So here we have a very nicely area, previous support, resistance, resistance, support, and also here on the last flip, it has become support. What we also see is that the market is making a lower high after hitting the higher time frame trend line. So we have a lot of confluence and we need to stack as much confluence as we can. Higher time frame primary trend, higher time frame level, higher time frame pattern, lower time frame level here that we're going to use for our breakout if the breakout occurs, lower time frame trend structure, lower lows or lower highs rather. Now we can see a few candles later the market has made it all the way through this zone. However, you can see the market has made quite a big push. So if you are a trend following breakout trader, you would get into this trade. However, some traders are not really comfortable with that approach and they feel that they are chasing the trade and chasing the trend because the market has already made quite a big move. And what you would do then in this case is wait for a retest. You can see a little bit afterwards, the market is now back at the level. And this is not the area where you get into a retest. Very, very important. And you're going to have a lot of problems if you trade retests when the market is reaching such zones, because there's a high likelihood that the market is just breaking through it. However, we can get another confluence point and another level of confluence by waiting and seeing what is the reaction of this. Are we getting momentum away from the zone? How's the market reacting to the previous lows? And keep in mind, we are trading into this bigger picture downtrend. So we don't need to be first. We can be patient because there's a lot of downside potential here that we can wait for. So let's just wait for a little bit longer and see what happens. So first of all, the market moved higher through your area. This is why you don't blindly trade those levels. Second, the market struggled at the previous lows. And it came back here even a second time to this area of confluence. And then, only then, did the breakout into the new low confirmed. And you can see now we are looking at a very different picture, because now we are looking at a wave 3 continuation on the lower downtrend. So we have wave 1. Wave 2 is this consolidation, and wave 3 is the with the trend play. Wave 3s are in general higher likelihood trend following opportunities, just as we have seen in the previous trade example, where we are trading a wave 3 on the higher time frame. Now we are trading wave 3 on the lower time frame, and we have so much confluence now on our side. We have the higher time frame, and we have so much confluence on the lower time frame as well. And then obviously where you got into the trade, you can put your stop loss above this range, you can put it in the middle of the range. You have a few options. You look left for where are you going to put your targets. You have options for targets as well. As I mentioned in the previous examples, the wider your target, first of all, the holding time will go up, which may be challenging for a lot of traders because you have to hold the trade for a longer period. Also, the chances running into a weekend holding, an overnight holding, or into a news event is also increasing. And of course, the wider your target, the more likely it is that the market is going to hit a level and then return and move against you, and you're going to give back your profits. So targets is a tricky topic. And you always have a choice between close targets or wide targets. So play around with it, really understand what type of trader are you, what does feel natural to you, and then you can find the right target approach. Trade 4, strategy number 4 is a trend following approach with multi-time frames. And also I'm going to talk a lot about risk management tips. How do you design the risk? And how do you find the perfect entry for your level of risk appetite? Step 1 is we always want to identify the primary trend. So we're looking at this chart, and the primary trend should be pretty crystal clear. It is down. The market was in an uptrend here. It topped out, making the first lower highs, and then ever since it made lower lows and lower highs. We can also look for confluence. Confluence in this case comes in form of a trend line that we can very nicely apply here by connecting the highs, and then we get some nice areas of confluence. We get more confluence when we look closer into value areas. Previous support turns into resistance, and also is resistance here at the trend line. We also have a very nice trend line here on the lower end, so we can see that the market is consolidating in this triangle. Now we can zoom in even further, and now we're going to start to develop our trading plans. So we want to make sure that the market is breaking out of the recent consolidation. It already kind of did break out of the trend line to the downside, but we also have a very important flip zone. Support turns into resistance multiple times, and the market is retesting the trend line from underneath and still trading here above the support. So a trading plan would be, if the market can get below this area, then we would look at a very, very meaningful signal. We are with the higher time frame trend direction, we have the higher time frame confluence, we have the lower time frame confluence, we have the lower time frame momentum with the breakout, and that would be a lot of confluence once again. We see that the market did break out very strongly, so this is another actually very important piece to the puzzle. Also, how did the market behave pre-breakout? With a lower bounce. So the market stuck here between the trend line and the support level, was never even able to reach the previous highs, which is a very important market tell, which basically means that the buyers who were into the market previously did not have any power anymore, and the sellers were able to take over, which is then further confirmed by this breakout strength. You can see this huge breakout is showing us that the buyers have completely collapsed. They are out of the market, and now it is back to the sellers, and the sellers are dominating the higher time frame and now also the lower time frame. And now we're going to look at trade design, trade structure. And first of all, stops go first, as always. Here's our entry. We want to make sure our stop loss is definitely above this support level. We also want to make sure our stop loss is above the previous high, so it's above this range. And this allows us to protect the stop loss very effectively and nicely. When we look at the trade structure in regards to targets, we have options. And we can look for important flip zones. So here, obviously, a very strong support level that led to the recent correction. The next one to the downside is this flip zone, previous support or resistance 3 times. We have this area here, very strong support level, and this one. So we have 4 levels that the market is offering and that we can choose from. And so what are you going to do now? Of course, you could say, yeah, the bigger the target, the better it is because I make more money. Whereas this is true in theory, if the market would just go through the big target, yes, that would make sense. However, obviously at each level, there's a very high chance that the market will bounce, which it did in the past. There's always a rejection at those levels. And also, the further away your target, the longer you're going to be in those trades. And again, there are just different risk factors are introducing. The further away your target is, the longer you will in the trade, the more news events will come out in between. And also, maybe you have to hold the trade over the weekend, maybe overnight, which not everybody is comfortable with. So really understand and ask yourself, what is your risk profile? What are you able to tolerate? And don't just accept a trading strategy or risk target factors, target strategies from another trader, because the strategies may be working for another trader, but maybe not for you. And this is one of the main priorities and focus points when traders come to us in our mentoring group, is that we really try to understand what is your risk profile, and we help to open your eyes for the different opportunities. How do you design actually a strategy that fits to your own personal profile? And you can see what happens afterwards. The market immediately went to target 1, went to target 2, bounced here a little bit, went to target 3, and then you can see this is now where the trade spent days and days just going nowhere. And if you are waiting for the 4th target, then you would have had a very bad time because you'd have needed to hold this trade for a long period of time. Now overnight feeds are coming in, which are going to eat up your profits. There's a lot of back and forth, which is also problematic. It's going to be very emotionally challenging. And in general, when new traders come to us especially, is that we don't recommend to have a strategy with a very wide exit approach. In general, when new traders are coming to us, we recommend have a closer target so that you're in and out of the trade quicker. You're going to have more positive, constant feedback with a higher win rate. And this is going to build your confidence in the beginning. And confidence is really important early on because trading by itself is already hard enough and you don't have to make it harder than it needs to be. So choose a target approach which gives you decent sized winning trades, but you're not holding your trade for a long period of time, and you can exclude a lot of those other challenging factors and also risk factors. And that's it. We are at the end of part 1 of our price action deep dive. I hope you enjoyed it. If you did, leave a comment, make sure to hit the like button and also subscribe. And I hope to see you again for part 2 very soon.